American Airlines reported a smaller than expected loss for its third quarter, and the carrier joined rivals in predicting a strong end to the year as corporate and premium leisure travel remain the industry's growth drivers. Let's take a closer look at the company's latest results with Stephen Trent, an independent aviation specialist. Stephen, thanks very much for joining us.
Thank you for having me on.
A little bit of a loss, but people seem to be happy with that.
Yeah, absolutely. So it was better than the street anticipated. And I think what's more important, the fourth quarter looks really solid, with the fourth quarter guide itself looking at the midpoint substantially better than what the carrier was just forecasting 3 months ago. So I think you have several of those verticals that American's been trying to improve, and I think we are indeed seeing tangible improvements.
And what are some of the improvements they've made? What are some of the changes?
Well, certainly you have premium cabin demand continues to string along very nicely. One. Two, main cabin is also starting to look up, and that had been a little bit choppy. Three, when we think about the labor cost outlook for this carrier versus its peers, American really already has all of its cards set, where we will see some adjustments to come, I think, from some of their competitors. And as we look into 2026, the co-branded card agreement with Citigroup should start to spool up, which we think is, we think that's very intriguing.
And on the downside, what might be a hindrance? What might derail all this optimism coming up in the fourth quarter?
Yeah, look, so it's an airline, so there's a lot of exogenous factors out there. When we think about company-specific items that, let's say, could be a little bit challenging, certainly the pace at which they continue to add back corporate, add premium leisure, I think that's certainly a place to watch. But at this point, looking at the fourth quarter, here we are at the end of October. And for example, they're already giving very good indications, for instance, what they've been able to achieve out of their hub in Chicago. So the writing on the wall so far, I would say, looks very good for the fourth quarter. And I would argue it looks even better for 2026.
And what about the industry as a whole? What are your thoughts on it? We've had some good reports for the airline earnings. What are you thinking?
Yeah, certainly now versus pre-pandemic, we have absolutely seen structural adjustments, which I think benefit the network airlines. So some of that would include, for example, a shift in consumer behavior, including the way consumers purchase tickets. There's more premium leisure now. That's probably, at least in part, related to many consumers no longer in person in the office 5 days a week. So when we think about that advantage for the network airlines, Delta, United, American, and let's say Alaska as well, those four already have the infrastructure in place. Layer on top of that co-branded card remuneration. And if you're a discount airline, I would say it's going to be very hard to keep up with the network carrier. So that post-COVID earnings wallet share gain you've seen for the network airlines, we think that is structural and sustainable.
And is there one of those that appears to be taking the lead on all that?
Certainly, Delta Airlines is well known for having a really good brand and being a really well-run airline. I don't think anyone in aviation is going to deny that. I would argue among the network airlines, quite frankly, American's going to be the surprise. So there's been sort of a long drum roll about how much debt it has, how its margins haven't caught up with Delta's and United's. They are actually laying the groundwork for potentially substantial improvements as we look into 2026. Their labor costs are already set. They have, yes, higher leverage, which is on its way down. But part of the benefit of that is they have the youngest mainline fleet of the big three. So there's not a lot of capex they have to do versus their peers. And I would say that's the one that has been at least somewhat ignored by the street.
And they did lift their capex by $500 million based on those earlier than planned aircraft deliveries. You're optimistic about everything with AA.
Yeah, look, and I think that the capex rise was actually relatively modest versus the capex you're going to have to see coming through for some of the carriers' competitors. And I would argue that the street has ignored that. And there's been some drumroll about just wanting to talk about Americans' leverage and nothing else, which I would argue is unfair. And looking at its equity market cap today, it's below COVID era levels in sharp contrast with Delta and United. That in my mind looks and smells like an opportunity.
Okay, we'll leave it on that note there. Stephen, thanks very much for joining us.
Thank you for having me.
Stephen Trent is an independent aviation specialist.